Okay, we're back. Starting our second video. We've still got the same spreadsheet open on the screen. I did label the second tab as balance sheet since that's what we're talking about on this sheet. And before we move off from a balance sheet, I did want to point out that we were talking here about a sole proprietorship and a service business. So let's talk about how the balance sheet would be a little different if it wasn't a sole proprietorship and it wasn't a service business. Really simple changes. So I'm going to scroll down here. Sorry, probably driving your eyes completely batty. What if it was a partnership? The only difference would be the equity. You would say, I got to give our partners names. Sharon, she would have her equity, and Kathy, she would have her equity. Our two partners would each have an amount of equity, and together that would make the total owner's equity. Let's move these two over so that they get a little bit of room, and the total would be here. So instead of just being one line saying owner's equity is this much money, we would actually have a separate line for each owner. And then the total here would be what we'd see in the accounting equation. Assets minus liabilities would make this number. So not a lot of difference, not a huge step to go up to a partnership. And a corporation, only difference is in the equity section. So again, the only changes are in the equity section. Assets and liabilities are going to be the same as what we saw before. You know, if the company didn't do lawn care, then obviously its assets are going to be different. They do something completely different, but it has no bearing on how the company is organized, as if it's a partnership, corporation, or so on. And these should be bolded. So, okay. Corporations, their owners are called stockholders, and there are millions and millions of stockholders. So there's no way we'd list everybody's name and say equity. We have an account called common stock, and in that is the par value of the stock. I'll explain that in a minute. And then there might be an account called paid in capital, sometimes called a PIC account. See the PIC for paid in capital. That's where you get PIC. Paid in capital, this is the extra paid by stockholders. It means above par value. Okay, so let's get into the discussion of par value so you can follow along with what I'm saying. Every share of stock has this almost like a denomination on it. We might say it has a $1 par value, a $5 par value, even some fractional amounts, $1.07 of a dollar, some crazy numbers, but we're going to stick with real simple, like $1 par value. That is an arbitrary number that's put on it when the company was first organized. It's usually not related too much to what the stock sells for. So a share of stock may sell for $11, but have a $1 par value on it. So when somebody buys, or a stockholder buys into the company, they buy a bunch of shares, they're paying $11 for each share. So $11 per share. They buy 1,000 shares. That's $11,000. 1,000 of it, or $1 per share of what they bought, would go into the common stock account. But they paid an extra $10 above the par value for each share of stock. So they paid an extra $10,000 above that for the stock. So you would see these two accounts, and together they're going to equal all the money paid in by the stockholders to buy that stock. And you're also going to see something called retained earnings. And that represents profits earned in the business. I want you to come back to the term retained earnings. Retained meaning held on to, and earnings. Earnings the company has earned that the company decided to hold on to reinvest in the business. In other words, the only other choice they've got with it is to give it away. And who do the profits belong to? Well, pretty much they belong to the stockholders, the owners. So they could, as a board of directors, say, this year we had a wonderful year and we need to share the wealth. We need to give some of this back to the stockholders. They do that by paying dividends. So they take some of the profits the company made that year and they give it to the stockholders. They mail it out as checks. Those are called dividend checks. And the company is going to do that because they need to keep the stockholders happy. Remember, the stockholders chose to buy into this company, and they can choose to get out of it by just calling their broker and saying, I am done owning that company. So there's always a delicate balance by management to keep the stockholders happy. So one of the ways they do that is by making the company really profitable, so the stock price on that company will go up, and they'll feel like, oh, I bought this stock for $10 a share, or $11 a share is the example we were using, and now it's selling for $45. I'm making lots of money. So stockholders happy when their stock price goes up, and they're also happy when they're getting their dividend checks. So management's job is to kind of balance all that out and give the stockholders what they want without giving them so much that they don't leave any money in the company for the company to keep going with. So we're going to see a few more accounts in the owner's equity section of a corporation. We'll learn more about these and play with these much more as we go on in chapters. But all that to be said, a balance sheet didn't change at all in the asset section or the liability section, depending on how it was owned. Now, what if it isn't a service business? What if it's a merchandising business? Meaning a business that sells products. They don't make the products, they just sell them. So they buy something ready to put on their store shelves and they sell it. And they make a profit, hopefully, by selling it. Well, the difference is for that company, in the assets, they have another asset called inventory because they have something they own, which is all that merchandise on the store shelves. So they have a new asset that the other companies don't have. Liabilities are pretty much going to be the same. And equity is going to look of one of three ways. It's either going to be a sole proprietorship and look like what we've been talking about, or it'll be a partnership, or it'll be a corporation. So really, a merchandising business just brings in one new asset. So not a huge deal. Okay, most complicated of all is a manufacturing business. So double complicated, manufacturing corporation. But just strictly in the manufacturing part, the assets are going to be different. And the way they're going to be different is there's going to be 3 inventory accounts. And I'll just talk about what they are. Raw materials, because a manufacturer takes raw materials, whatever it is. I often use the example of like a furniture maker. They're going to have wood, fabric, padding to put in there, glue, thread, things to put stuff together, maybe sandpaper and varnish and stain to make the furniture. So all those things are called their raw materials. That's their inventory of stuff that isn't put together yet. Then they have one called work in process. That's just an inventory account to keep track of the stuff that's half done right now. If you went out on the factory floor and saw that one couch that's half done, and you saw the table that they're just starting on, All those things are called work in process. They're items that they're going to sell eventually, but they're not done yet. And then they have one last one, which is called finished goods. Finished goods is pretty much the same as the inventory up here a merchandising business has. Finished goods are the stuff that they have finished, and they have them available to sell. A manufacturer generally sells to a merchandiser. So the manufacturer makes the furniture, and then he sells that furniture, or she sells that furniture to a merchandising store that's going to display this completely made couch, table, whatever, and sell it to the end customer. So a manufacturer has 3 assets. That's all the complication that comes about there. So again, not a huge deal to add in these new things. When you go in to the textbook, you will see what seems like an overwhelming balance sheet. So we're going to go there for a minute and try to take everything we've learned and go, okay, I think I understand this thing. Kind of take us from the simple, what we've been doing on the chalkboard stuff, to the example in the book. So I'm going to share a screen and flip over to looking at the textbook. Now you should be able to see what is page 36 of the textbook. It is Kramer Corporation balance sheets. Now, one thing we haven't talked about is that oftentimes when you look at an annual report, they will show you the balance sheet, but they'll also show you last year's balance sheet because it helps to compare. So this is the balance sheet for 2013, but they gave us 2012 also so that we could see how the 2 years compare. This is year end. A balance sheet is always a particular date. So if this company's year end is December 31st, this is all the numbers as they were December 31st of 2013 and of 2012. This company has assets, and skipping all the detail, they have $1 million of assets in 2013. I'll get back up into the detail, but I don't want to get too lost in it at the moment. Then they have a whole bunch of debts. They turned all those pink. $300,000 is the grand total of all their debts. So the $1 million of assets that they could use to pay off these $300,000 of liabilities, and that would leave them $700,000 of equity. Remember, this is a corporation, so the owners who have this equity are called stockholders. But together, all those stockholders share $700,000 of equity in the business. And just to kind of help with the accounting equation, remember the accounting equation says assets equal the liabilities plus the stockholders' equity added together. So the balance sheet says liabilities plus equity added together is $1 million. Just to kind of really show the reader that this totals $1 million, which matches the assets up above. Okay, so it's still the same accounting equation. It's just that their list of things is so much longer than we're used to seeing. So let's come up with the assets. The first thing we notice is that they have these like subcategories. Current assets, and they list a bunch of them. And then they total just that group of assets. Then they have this thing called investments, and they got another group, plant and equipment, and they total plant and equipment. And then finally they add them all up. So let's talk about what's the difference between a current asset and plant and equipment and investments. Current assets are those things that you're going to turn into cash or use up within 1 year. So cash, it's already in the form of cash. Marketable securities, a big old fancy word for really short-term investments that you have that you can sell really quickly, like CDs at the bank might be considered marketable securities if they've got a short enough maturity date. If you have some money market funds that you could get, you call your broker or talk to the bank who's holding that, and you could get the money out within a few days. It's a marketable security. often you will see cash and marketable securities merged together. So don't be surprised if that doesn't show up very often and it's just lumped up in the cash line. Accounts receivable, you know what those are. This has the word net after it. Without going into huge long explanation, it's saying that $200,000 is the amount their customers owe them. Just understand that could actually be higher. They could have $215,000 owed to them by their customers, but they've gone through and looked at some of those customers and their accounts and said, I'm starting to feel like we're never going to get payment from that guy or this guy, or so they will lower the amount on the balance sheet to not mislead the reader. They will say, here's what we really expect to get out of our accounts receivable, which is $200,000. Probably in the footnotes, you'll see the whole story that says we are technically owed $215,000, but we're feeling a little shaky on the $15,000, so we're saying $200,000. Inventory, it's the value of what they paid for it or what it cost them to make those items that they now have available to sell. And those they hope to liquidate within a year, so that puts them in the current asset category. And prepaid expenses is a big fancy way of saying things like prepaid insurance. And again, that's usually going to be used up within a year. So all those current things together make $450,000. Long-term investments are things the company has bought into, not to use, but for investments, like stock in another company. Or they bought a piece of real estate that they're not using to do their business, but because it was at a really great intersection and someday it's going to be a valuable piece of property and they can sell it and make a bunch of money. So it's an investment for them. Then jumping over to this category, it's hard to see, but 2013 is really these two columns and 2012 is really these two columns. But because they're going to subtract these two numbers, they push them off to the side to show that they're subtracting them and then to show you the subtotal. So 1.1 million minus 600,000 makes 500,000. And that's going to get added with all these other ones. But what this is the plant and equipment. That's their equipment, their factory, their vehicles, all those long-term assets. All together cost them $1.1 million when they bought them. But they've been depreciating them as they went along, and now they're down to 500,000. So that is what's going to get added up into our assets to make $1 million of assets. So when you see a balance sheet, you may see subcategories of assets, and you may see subcategories of liabilities. The liability categories are really pretty straightforward. Current liabilities, long-term liabilities. Current, things I'm going to pay within the next year. Long-term liabilities, stuff that isn't going to come due for several more years. So $90,000 is owed in 2017. So that's considered long-term, where all this stuff totaling $210,000 is going to be paid in the next year. But altogether, our liabilities are $300,000. Okay, I think that's enough about a balance sheet. I am sure you're getting tired of listening to me. And I still have to talk about the income statement. So I'm going to bop back over to the Excel worksheet, and we can talk about income statements. And statement cash flows is going to be a very, very short thing. You won't be preparing them. You're just kind of introducing them in this chapter. So give me a second and we'll switch spreadsheets again. Okay, back to our spreadsheet. I'm opening a new sheet that we can use for the income statement. Okay. An income statement helps tell the reader, the user, whoever is using the financial statement, to get information. Did the company make a profit? What goes on there is something called revenue, which is work done or products sold to customers. this period. An income statement always covers a period of time. If we do lawn care service, our revenue might be called something like lawn care revenue. Big fancy title. If we sell products, then our revenue might be called sales. More descriptive of how we do our revenue. So revenue is the category, and usually there's a name. And if a company does a little of both, they'll have 2 or 3 revenue accounts just to explain the different types of work. Even our lawn care snow removal business, they could have lawn care revenue and snow removal. Or they could have commercial clients, so they could say revenue from commercial, like businesses that they do work for, and residential revenue, depending on how they want to break it down and what statistics mean to them. But they're recording every job they did, just whether they categorize them or just lump them all in one account. So your income statement will have revenue on it. It'll also have expenses. Expenses are the costs incurred to earn the revenue. So what cost did you incur while you were doing the lawn care or while you were selling products? The biggest one for a merchandising business is something called cost of goods sold. It is literally the cost of the items or goods that were sold this period. I'm going to step over here and kind of make a mini income statement. And this is going to be for a merchandising business so that we can see how this works. So our revenue would be called sales. And let's say that we sold 1,000 products and we sold them for $5 each. So we'd say we had $5,000 of revenue. Well, we had to buy those products before we could sell them to somebody else. So I'm going to abbreviate cost of goods sold, coming right from here. The cost of the items we sold. We sold 1,000 products, but hopefully they didn't cost us $5 when we bought them, or we wouldn't make any profit on them. So I'm going to say they cost us $2 when we bought them. We marked them up and sold them for $5. So we would stop and subtotal and show our reader that we made a profit on this. 5,000 minus 2,000 means we had a profit, and specifically we call it a gross profit of $3,000. And another note, sometimes called gross margin. For whatever reason, there are 2 ways to refer to this, and I don't want you to get confused when all of a sudden you're so used to me saying gross profit and some textbook example says gross margin. You're like, what's this? They're the same thing. So as much as I can, remember, I will try to say also called, can be called this or that, in case there's extra names. But that's not the whole income statement. There are more expenses. So the next thing they do is list all the other expenses. Sometimes they break them down and show 1 or 2 expenses, then subtotal, and 1 or 2 more and subtotal. I'm going to make a more simplified one. We go look at the textbook, you'll see what I mean about the complications. But some of the other expenses could be, we pay salaries to our employees. That would be a cost of doing business. And insurance. We might have depreciation. We would have all these expenses. We would list them and take them away from the gross profit. So I'm going to make up some expenses here. And yes, I am literally just making up the numbers. Okay, I've got $950 of expenses to take away. So when I'm done, I'm going to get something called operating income, and I don't really need the colon at the end of that. But that's what I'm going to call the subtotal. And 3,000 minus this one, minus this one, minus this one, gives me just over $2,000 of income. If it's a corporation, they have to pay taxes on that. And taxes may be like 40%. And 40% would be $820. Take away that decimal place there. So then we would say we had net income, meaning not gross, but net. And it could also be called net profit. So I changed the word from referring to as profit up here to income down here. They mean the same thing. So 2,000 minus 800. And we finally came out with a profit of over $1,200 from making $5,000 worth of sales. We cleared or kept $1,230. Hard to say if it's good or bad. It's definitely good that we still have some profit, that there is some left out of the 5,000. How were we last year? How are other companies like us doing? Do they keep that much? They keep more out of every sale? Independently, 1 year by itself is awful hard to decide good or bad. You need competitors, how everybody's doing, how we did in the past, what trends are going on, but at least it's nice to see that it's profitable. You might hear things like, the company's in the black this year, or how is their bottom line? This is called their bottom line. If it's positive, it's written in black. And typically anymore, all numbers are written in black. But it used to be when you used adding machines or typewriters and a negative number, the ribbon would move up and it would type a negative number in red. And you imagine if we came down to the bottom of our income statement and we did these subtractions, we came out with a negative number. That wouldn't be good news. That would mean that all these expenses were higher than any revenue or sales that we made, and we ended up with a loss. Yeah, I managed to hit that button good, didn't I? Okay, let's go back over to where we were. The net income here is positive. So when we see black, if someone talks about how was your bottom line, oh, we're in the black this year. It's a good thing. We are at a positive number. Oh, we're in the red. They mean they have a net loss, that the number would have been typed in red because it was negative. So that's where we're going with this. This is an income statement. This is kind of a moderately complex one. I'm going to take you back to the textbook. We're going to look at a few of them, and we're also going to look at some homework problems and see how all this information makes sense and what it means. So again, bear with me as I share the screen and switch to sharing the textbook. Okay, we're back on page 36 because that's where I left the textbook when we switched away from it. But what we need to do is go back to the early part. The textbook introduces the income statement first. It's the very first financial statement that they introduce to the reader. Here we go. Beginning of the chapter, second page of the chapter, page 26, same company that we looked at the balance sheet for, Kramer Corporation, they show us the income statement. Income statements typically do not have numbered lines, 1 through 14 or whatever number. The textbook did this so that they can tell you, please refer back to line 3, and then they'll go on and tell you about gross profit, just so that they can tell you where to look on the income statement. So don't go looking for those lines anywhere else other than textbook land. They don't exist. You can see these first 3 lines are just like we were talking about. Then they list some expenses. And this is kind of more like a category of expenses. All the selling and administrative expenses, depreciation, operating profit. I called it operating income. And they also call it EBIT. Earnings before interest and taxes. You see, interest comes after and taxes comes after. So it says if we stop and subtotal before we paid interest, or before we showed how much interest we paid, and before we show our taxes, this is what our total would be, $180,000. Then if we take away our interest, earnings before taxes. In other words, they took away the interest in that because it's no longer before interest. And then finally, what I've been calling net income or net profit, they're going to refer to as earnings after taxes. You're going to see all 3 of those terms. So please feel free to kind of use the terms interchangeably. The most important thing is when you read a story problem, whichever one of those 3 terms it uses, you're comfortable with it. Line 10 is where I stopped our income statement, because that technically is the bottom of the income statement. The rest of this is trying to explain to you what happened to that $110,500 of profit. Line 11 is saying that this one category of stock, you have common stock and sometimes you can have preferred stock. Special customers, special owners, stockholders, called the preferred class of stockholders. And then they get their dividends first. So they've made up a number and said $10,500 of this year's profit will be given to those guys. Line 12 is saying, okay, then there's $100,000 left over for the common stockholders. Not that they're going to get it all, because remember, the board of directors has to decide out of all this profit this year, what's going to happen to it. We got to keep some to keep us going for next year, and we've also got to keep the stockholders happy. But lines 13 and 14 are saying, hypothetically, if they were to take all this money that's available to go to the common stockholders, how much would each common stockholder get? And to make the math nice and easy, he said, well, let's pretend we have $100,000 and we have 100,000 stockholders. You divide that, it works out to $1 a stockholder. That's called earnings per share, and it's going to be a really important number. We're going to see earnings per share in a lot of chapters. So hang tight with that one. Make sure you understand line 14. Okay. Like I said, throwing lots of stuff at you. Let's go to the end of the chapter where they show homework problems. And I'm going to buzz there just a little quicker. Problems. There we go. At the end of the chapter on page 47, they show a sample problem. Those are always worth looking at. Actually, started on page 46. It looks like a homework problem. There's the practice problem. There's all this story. Another practice problem. And then you turn to page 47, and they've solved the problem. So if you have a homework problem that's a lot like that problem, you can see what their solution was and pattern yours. And obviously, that problem asked them to prepare an income statement because that's what they did. They made just exactly what we were looking at. They made an income statement. And then in part 2, they had to compute some things that we'll talk about in a few minutes. But after that, all right, you start having problems at the end of the chapter. Quick definition of or title of what this problem is going to involve. Okay, number 6. Here's a bunch of information. Looks like it's almost organized into an income statement. When it says income statement, there's a bunch of income statement stuff here. So you start looking at it and go, that's not in the right order. That's all they want you to do is unscramble it and make it look like the example they gave you in the book. Remember, the example in the book had 14 lines. You probably are not going to need all those lines. You may not have some of those things in this example. So when you don't have it, you don't need to list it. It's an example that includes everything. So when it's relevant, you'll know where to put it. When it's not relevant, you can skip it. So this isn't a homework problem that you have to do, but it was an example of something you could practice with. If you ever want to do extra homework, I know that just goes contrary to any student thought to do extra homework, but if you want to practice with some things, feel free to do these problems, send them to me. I'll look them over. I'll give you feedback on them. You get stuck on it and say, I thought I wanted to try that, and now I don't know what to do. We can talk about it. Same thing here. Number 7, make a good income statement out of it. Your first problem is number 9. So let's look at what you really have to do. And it is prepare in good form. It means in the proper format, an income statement. So there you go. You have everything you need to do to make one look like the page we were on earlier in the book. You got to make an income statement. Then you have to do number 15. And sorry, turn in pages to find out where it's going to be at. 15 is make a balance sheet. So you're going to take the lecture and turn them into the 2 things we talked about, income statement and a balance sheet. And then from there, you have to do the price earnings ratio, which you don't understand completely yet, and 25, which is book value. What I'd like you to do is practice 9 and 15 from what we've talked about here, then read the chapter, and I bet you figuring out price earnings ratio and book value will be a breeze because you'll have understood the balance sheet and income statement. So I'm going to sign off. I'm going to take time to download and upload these videos to YouTube, send you the link and the file, and you should be all set. Let me know if you have any questions.